What if the perfect dividend ETF already exists, and you've simply never heard of it? Not some tired fund with average returns and slow dividend growth, but a game-changing ETF that's quietly outpacing tech giants, paying rising dividends, and beating the S&P 500 by a full 10%. Even more shocking, it's tripled the returns of SCHD, yes, that SCHD, while flying completely under the radar. Today, you're going to discover this overlooked powerhouse, and by the end of this video you'll understand why smart investors are piling in at record speed. But before we dig into what makes this ETF so unique, be sure to subscribe to MoneyQuest Broker for weekly breakdowns on top-performing ETFs, portfolio building strategies, and insights the mainstream channels often miss. If you're serious about building wealth with both income and growth, you won't want to miss what's coming. Now let's get into why this dividend ETF isn't just another fund, it's a redefinition of how income and performance can coexist. For years, dividend investors have faced what I call a false trichotomy. You've been told there are only three choices, and none of them are perfect. First, the passive dividend ETFs like SCHD, reliable, modest yields, and solid companies but often underwhelming in bull markets. Then you've got the covered call ETFs, popular for their 10 to 12% yields, but they do this by sacrificing nearly all your growth potential. Finally, the actively managed dividend ETFs, which promise expert stock selection but often struggle with inconsistent payouts due to constant turnover. It's like choosing between bland, greasy, or unpredictable, and none of them are satisfying if you want both consistent income and long-term capital growth. But what if this entire framework is flawed? What if the idea that you must choose between income and growth is an outdated myth? That's where two little understood but critical ETF factors come in. They're rarely discussed, but separate the exceptional funds from the average ones: momentum and turnover rate. Let's start with momentum. It's the investing equivalent of surfing a wave that's already building. Momentum-focused funds identify and hold companies already showing strong price performance. Because in markets, strength often breeds more strength. It's a principle that underpins some of the top-performing funds across all categories, yet most dividend ETFs ignore it completely. Then there's turnover. At first glance, a higher turnover rate sounds proactive, managers constantly optimizing the portfolio. But here's the problem. For dividend-focused investors, high turnover can be a killer. Why? Because it often means missing dividend distribution dates or losing out on qualified dividend tax benefits. And it introduces inconsistency, something income investors can't afford. So what if you could capture market momentum while keeping turnover low enough to allow dividends to grow consistently? Until recently, that combination was basically a unicorn. But one ETF has cracked the code. It's called SCHD, and it might just be the most complete dividend ETF in the market today. Launched in early 2022 by the Capital Group, SCHD didn't just hit the ground running, it roared onto the scene. In under 2 years, it's amassed nearly $16 billion in assets under management. That's an unheard-of growth rate for a new fund, and it didn't happen by accident. SCHD isn't just another dividend ETF. It's a radical rethinking of how dividend investing can work. Despite being brand new during the brutal 2022 market downturn, SCHD only dipped 2.89% compared to the NASDAQ's 20% freefall. And when the bull market came roaring back in 2023, SCHD didn't just recover, it matched the growth of the S&P 500 and outpaced SCHD by a staggering 5 times. It even kept pace with the NASDAQ 100, an ETF practically synonymous with growth. That kind of dual performance, defensive in bear markets, explosive in bull markets, is incredibly rare. So how does SCHD pull this off? Its success lies in a series of deliberate and strategic decisions, starting with sector allocation. Where traditional dividend ETFs often load up on industrials and utilities, SCHD takes a much more balanced approach, almost equal weightings in tech and industrials, with healthcare coming in strong as well. This isn't just random diversification, it's a calculated strategy to capture both the dependable income of traditional sectors and the explosive growth of innovation-driven industries like AI. This smart sector blend lets SCHD borrow the best parts of growth ETFs like the S&P 500 while holding on to the defensive qualities of dividend stalwarts like SCHD. In essence, it plays both offense and defense without compromising either side. And behind this strategy is a unique multi-manager structure. Instead of relying on a single portfolio manager with one perspective, SCHD is run by 5 separate managers, each with their own style, discipline, and area of expertise. It's like assembling a dream team of investing minds, all focused on finding high-quality companies with both dividend potential and growth upside. That internal diversity gives the fund a level of adaptability and resilience that few others can match. But none of this would matter if the dividend strategy didn't hold up. Fortunately, SCHD's dividend philosophy is just as impressive as its capital growth. Here's how it works. The fund screens for companies with at least a $5 billion market cap, a minimum 1% dividend yield, and, critically, a 3 out of 5 year history of increasing their dividend. But the real secret sauce? A strict 60% payout ratio cap. This ensures the companies aren't overextending themselves just to pay dividends. Instead, they keep enough earnings to reinvest and grow. That balance is crucial for long-term wealth building. Too many high-yield ETFs chase dividends at the expense of quality. They load up on companies that pay a lot today but can't sustain it. SCHD avoids that trap entirely, and it shows. In its first year, the ETF boosted its dividend by more than 50%, more than tripling SCHD's own first-year dividend growth, all while maintaining a turnover rate of just 30%, nearly identical to SCHD's 28%. That's the magic growth level performance with SCHD level consistency. Now consider this. Actively managed funds like OMFL chase market trends aggressively, but with turnover rates north of 300%, they rarely provide consistent dividends. SCHD, on the other hand, has found that perfect middle ground, dynamic enough to harness momentum, yet stable enough to hold long-term dividend growers. This is exactly why the fund has seen such explosive inflows. In a bear market, it held strong. In a bull market, it soared. That kind of adaptability paired with real income growth is incredibly rare, and investors are noticing. Yes, SCHD is still new, and long-term data will tell us even more. But its early track record, navigating both extreme market conditions with success, is a very strong signal. It's already proving itself as a reliable core holding for dividend-focused investors who don't want to sacrifice growth, and that's a demographic that's been underserved for far too long. In the world of ETFs, it's rare to find a fund that genuinely moves the needle. SCHD isn't just another dividend product. It's a fundamentally different approach. It blends momentum, stability, income, and long-term appreciation into one cohesive package, and in doing so, it challenges the very idea that dividend investors must choose between income and performance. For those who've been frustrated by that false choice, this could be the solution you've been waiting for. The question now is simple. Will you wait until everyone else catches on, or will you be ahead of the curve? If you found this breakdown helpful, subscribe to MoneyQuest Broker right now so you don't miss the next deep dive. Thanks for watching, and I'll see you in the next video.